Hello, everyone, and welcome to Ventures. I'm excited about today's episode with Dave Parker. His new book, Trajectory. Those who are on video here, I have it. Trajectory Startup, Ideation to Product Market Fit is full of gold for founders that are going through the process of building a startup, forming a team, selecting how they think about their revenue model, and more. So he and I get to talk about his story, why he wrote the book, how his journey as an entrepreneur informed how he thinks about the world of business and startups. And we talk about even the emotional ups and downs and how to seek advice and how to approach the venture capital industry and more. So I'm excited to share this conversation with you. If you are listening, you can also watch by visiting wclittle.com, and there you'll see more extensive show notes to the things that we talk about today, and I'll be sure to link to a lot more of Dave's resources. And if you are watching, you can also listen anywhere that you get your podcasts. You can just search for Ventures. So with that, please enjoy this conversation with Dave Parker. All right, Dave, welcome to the show.
Thanks, Will. Glad to be here. Yeah, fun to catch up on all kinds of fronts.
Yeah, no, I've really enjoyed working with you, getting to know you the last decade or so, and I'm amped for this conversation and to dive into the book that you have cranked out here recently, which many of colleagues and I are really amped to share with the founders that we work with, and the material in there is fantastic. So well done. Would you mind just starting by telling us a little bit about your story, your journey thus far?
Yeah. So 5-time founder, sold 3, closed 2, one in a pretty epic failure, like, Crater Dome kind of sense. Raised about $15 million, exited about $85 million. So all singles, no unicorns, no fairy dust, or pixie dust, I should be. So I got different things to go with. Right. So raised in a little town in southwestern Washington. Father was not an entrepreneur. My grandfather, however, was an entrepreneur, and he owned the first Ford garage in 1911 in Camas, Washington. Which fun, History Channel fact. They didn't actually start the assembly line until 1913. So they sent parts of the Model Ts out to the field where they would reassemble them. So he was an early, when new trends come out, right? He was a new trend guy, and he jumped onto the Ford auto. He sold it too early, but he started the first phone company in southwestern Washington. You see there's a little phone back there, as the next business, and sold that too early too. So I think this next month will close my 14th transaction. So by contrast to him, the answer is I sell them all if I can.
Nice. And where did the entrepreneurial bug for you? Like when did you start? Was it super young, or was it a little bit later? When did you realize the entrepreneurial bug was in you?
Probably unemployable. That was probably early indication that I didn't know how to read at the time. Early on, worked in the photography industry and was very entrepreneurial there. With had I had a little bit different mentorship, I probably would have stayed a professional photographer. I worked for United Press in high school and sat on the floor of the Portland Trailblazers for 2 seasons, and honestly didn't know how good I had it. And for a little adult supervision, I probably would have excelled there. Got to college at the University of Washington. Remember the movie Caddyshack? That's how I got to college. I applied to one school because I had one scholarship, or I wouldn't have gone to school, and then spent summers working back at the paper mill in the town I grew up in. So, which was a good driver to get you back to college. Like if you wanted motivation to get back, the answer was, yeah, go work in a lime kiln, or do something crazy like that. It was a good motivator. So. First company was in 1998, though I was, doing my own consulting sort of stuff off and on prior to that. But I kind of recognized early on that it's like, I like my own ideas best, and I can join a train that's that's rolling, but I probably only can join it for a little limited time.
Yeah. Right. So tell us about your journey with Startup Weekend.
So Startup Weekend, for those of you who don't know, is an event that happens globally. My first Startup Weekend experience was at Seattle University about 11 or 12 years ago. It could have been 13 years ago. Yeah. And I took my son, who was then 16, And we went in, and I was a coach and a judge. So you show up on the way the program works is Friday night, people come in, about 125 people. People will stand up and pitch their ideas, and people will join their teams, and then they launch a demo or prototype by Sunday evening in front of a group of judges who give them feedback on the idea. And we went in Saturday morning to kind of be a coach and wander around and talk to all the tables, and people had broken into their teams at that point, and they were still super high energy because they had got little sleep on Friday night, but would get even less sleep on Saturday night. And my son walked out of there for the first day, and he's like, there were some really stupid ideas there. And I'm like, well, that's always the case. But think of Startup Weekend as kind of like a pickup basketball game for startup founders, right? To give you a chance to validate your idea. And give everybody context, we sold that company to Techstars in 2015. But the prior 12 months to that, we had done 1,265 events worldwide in 120 countries and with 74,000 attendees. So full credit to the team that I got to join in process was they had created a movement.
Yeah.
I think the average age of the team when I joined was 27, maybe 28. So I singularly brought up the average there. That's a good performance indicator. And we scaled the events from about 500 to 1,200 in the time that I was there. And we sold the company to Techstars, and then they made it part of their community program. So Startup Week, Startup Weekend, Startup Next, which became Startup Boost today, and then Startup Digest, which is the largest email newsletter in the world for startup curious folks. So super happy where it landed, and they're doing great programs today. Obviously, during COVID era, it's weird, but they're still doing great programs worldwide.
So for you personally, why startups? Like what is it about it?
I think it's like choosing a puppy,
Yes, it is.
right? I mean, sometimes the puppy chooses you, and sometimes you choose the puppy, right? I feel like startups are similar, right? So I don't know that it was a deliberate thing. Like my first startup I started in 1998. I was working for a large systems integrator. So I came through the telecom world, made the shift to IT staffing, IT services, and I think I'm naturally curious. Like I'm even curious about stuff I'm not curious about, right? I'm a business model junkie. I'm always looking for how does that work together? Like how's that business model work? So I was working for a large systems integrator in Seattle. Our biggest customer was Microsoft. So I ran sales for all the non-Microsoft side. And every month my Microsoft rep would come to me and say, hey, how much software are you guys going to sell? And every month they'd say, Rick, we don't sell software, we sell services. And after the, I don't know, 5th, 6th, 18th time we asked, right, I was like, wait a minute, am I the only one that doesn't sell software? He's like, nah, everybody doesn't sell software. I'm like, well, why is that? He's like, you got to figure out licensing. It's super hard. And it's just not, there's no margins in it. So we built a company called License Online. It was my first company. We built a configuration tool that allowed systems integrators to configure what the right software licenses were for their customers. And then we would do the transaction through to the small and medium business so that the systems integrator could take the sale, get credit for the sale with Microsoft, make a little bit of margin, but most importantly, keep account control and not lose their account to somebody else. So that company went from 0 to 32 million in sales in 4 years and 150 people. The scars on my back have healed, but I still get a little twitchy at times because in that phase of growth, you're like, it's ridiculous. And when you get past the first rung of people that you know, and you get into the next rung of people you don't know, like it's a kind of a crazy way to grow a business. We sold that company in 2002. If you remember back for your listeners to 2002, it wasn't a great time to sell a company. So post tech bubble, post 9/11. So we got the company sold, but it wasn't a great exit. And learned a ton. Would I say that was a success? Nah, I think it was kind of a failure. Like we returned some capital investors, but we didn't give them a great return by any means. So it was brutal timing, lessons learned, but I got the company sold. So people will often say, well, it wasn't a failure. I'm like, no, actually it was because I didn't return all the capital back to the shareholders. So from that standpoint, investors are big boys and girls. They understand that when they invest in a startup, sometimes you get returns, sometimes you don't. But for me, the only people that ever say, well, Dave, it wasn't really a failure, you learned something from it, those are the people who've never actually done this, has been my observation. Maybe it's not true, but for those of us who've done it and succeeded and failed, the answer is no, there's definitely successes and there's definitely failures. So So that was the first company, but it was really around the problem, like, aha, I saw friction, I saw a problem. Knowing what I know now, Will, around the data that we've done in the book, I'd be like, would I start that company again? Oh, hell no. Like, nope. Because you were in a business with margins were really tough, right? A friend of mine who's become a mentor is a guy named Dave Burkus. So he wrote 20 years ago wrote what was called the Burkus method for how do you value a pre-revenue startup company, which 20 years later is still the standard of how you value them. And Dave had a quote that said, "Where there's mystery, there's margin." Like there's, where there's complexity, you can find margin in that mystery. In the case of like Microsoft licensing, there was no mystery. Like there was wholesale pricing and a rebate percentage.
Yeah.
So we were going up against, our next biggest competitor was $1.2 billion. Those were the guys we sold to. And then we had a $13 billion and a $15 billion competitor, and Microsoft was our number one product. So it was kind of like dancing in a rotation with gorillas. You're not true till they are. And kind of a rough business to be in. And in retrospect, I'd be like, you do know there's very little margin in this business and not a lot of room for error. So I would definitely not start that business again, knowing what I know now.
So I have a million questions around your book, and for those that are watching, I have the book here with me, and really enjoyed so many different parts of it. And I actually remember when you and I were in Chicago. Let's see, what was this? 6-7 years ago. We were sitting down with a founder, and you gave him the business model spiel. You said, well, if you're going to start a marketplace, it's going to be this. Here's the dynamic. Here's the roadmap. You really helped me and others think about the reality that, hey, we've been playing this tech startup thing for decades now. There have been blazing trails. There have been trails that have been blazed ahead of us. And we may want to be little mini historians here and learn from people and learn how all these things happen. And so I really admired the way that you have, some people say that they're data driven. You, my friend, espouse this, even in the sort of the virtual green room before this conversation. You showed me a bunch of spreadsheets and data about multiples for exits on all these different business models. So I love that, admire that. But let's maybe just start with why write the book? Why this book?
Yeah, so two things I think from a why perspective. One is coming out of Startup Weekend, we'd see people on Monday morning, Sunday night, and they're like, "Woohoo! I met Will. We're gonna be co-founders. Oh my God, we're leaving our day jobs." And I'm like, "Whoa! Please stop! Like before you do that, there are some things you can know about your idea, right?" And so I will say there's been at least 3 unicorns I know that have come out of Startup Weekend, right? And one that people might know in the U.S. is called Rover. So Rover actually was a company that Greg Gottesman, who's one of our board members, and one of the venture capitalists in Seattle, went to a Startup Weekend and was like, "We're going to do Airbnb for pets." That was the idea, right? And it's valued at over $1 billion today. You know some folks there as well. But there were 2 other companies that were $1 billion companies that came out of. One was out of Brazil and one was out of Spain. And
cool.
What's interesting about it was, this whole thing of like the founder failure rate is so incredibly high, Will, and it's 70 to 90% depending on what source you believe.
Right.
And the first question was, well, how do I help founders not? There's 1,000 things that can skewer you while you do a startup, right? This is Indiana Jones and the Temple of Doom, right? Every time you turn around, there's something that can kill you. I can't keep you from doing that, but there are things I can help you do. So that was one of the motivators, was like, if it's 70 to 90%, can we bring that failure rate down based on data and based on what you can know?
Yeah.
And the second thing is that when you're doing a startup, time matters so much, right? So if I can help you do something in 6 months instead of 12 or 24 months, you can always earn money back, right? I mean, you and I both made money and lost money in enterprises. I can always make the money back, but I can never make the time back. So if I can help you compress the time,
right, then
mission accomplished. So number one was decrease the failure rate, and even a small way would make me super happy, and then compress the time it takes you to learn. So going back to your kind of previous point, is one of the things is demystifying this concept of, oh, it's in my business model.
Right.
And honestly, as a VC, I've been a venture capitalist a couple of times. It's never stuck. And because I'm always transparent with the founders versus like, I think your valuation is high, right? And because there's information asymmetry in venture, separate topic.
Yes.
So the question then came up of, well, it's in my business model. So in the book, I break down a Venn of what is actually in the business model. So think about this like doing a souffle, right? You have to have all the ingredients, you have to follow the recipe, you have to bake it the right amount of time, and if you slam the door around, it's going to fall. And there's a bunch of places within your startup it's super precarious. So the business model has three components in the Venn. Number one is how you create value. So creating value is your product or your service, your market, and your team. And think about this as all of the cost associated with building your product. So that goes into creating value. You could have a product, you could have a service, you could have a combination of the two. How many engineers does it take me to build it? What's that tech platform am I going to build it on? How am I going to support it? Who's going to host it? All of those costs are costs associated with building the product. So that's just one circle of the Venn. So the next circle of the Venn is how do I deliver the product? And delivering the product has a number of components as well. How do I monetize it? How do I market it? How do I sell it? How do I price it? Those pieces are the four components of how I deliver value. That's how the customer engages with me to buy the product. Now, I know some of the audience, because you and I know them all, right, is like, I just built a great product, people will find me. And the answer is no. Or at least they will not find you at scale, right? So you have a cost associated with building the product, and you have a cost associated with selling the product. So that's circle number two. The last circle is how do I capture value? And that is my gross revenue, top line sales, and my net profit. And it's an outcome that you can't change based on the previous two pieces of the Venn. If your price goes up to build it, your margins are going to go down. If your price goes up to sell it, your margins are going to go down. So if you look at it from that perspective, they're like, I'm in control of these variables, cost to build, and I'm in control of cost to sell. But the market impacts both of them. So that then gets you to a further breakdown of like in the cost of delivery, like how do I monetize this? How do I sell it? And I break down a lot of the what and the how in the book, but I really push people to say, you need to know your why first, and then I can help you with the what and the how. But I'm not going to give you the pontification reasons of why you should build a startup. Is it to change the world? Is it to make $1 billion? Like you got to decide that yourself.
Right.
But I can help you with the mechanics of what and how.
So what's your standard answer? I know you talk about this from various different angles in the book, but for those listening in who have maybe just bought the book or diving in, what is your answer to the question, what is a good idea?
Oh yeah, it's a great one. So in the first time we ran this I ran this as a program about 4 times before I finished the book. That was actually my MVP.
Yeah.
Right. So we were coming out of startup weekend and I'm like, all these people there. And I'm like, you should come to this thing we called 6 month startup, because we had, weekend event and a week event. And I'm like, 6 months sounds good.
Right.
Totally misbranded it in retrospect. different topic. But one of the people in the very first sessions came up to me afterwards and they're like, oh, this was awesome. And I'm super inspired and I want to be a founder, but I don't have an idea. And I was like, part of me is thinking like, how did you get in here? Because this is all about how do you take your idea and grow it. And in an unusual manner for me, I said, let me come back and be thoughtful about that answer instead of being flippant about it. So I actually took it away, and we actually wrote a chapter about it, or I wrote a chapter about it in the book, about here are 11 frameworks for what makes good ideas. They're not designed to be all of the frameworks, but the concept there is like Rich Barton's power to the people thesis. That's his investment thesis. So Rich, for those who don't know, started Expedia within Microsoft and then spun it out. It was the first company to spin out and go public from within Microsoft. And then Rich went on to start Zillow, that obviously took public as well. And then became chair. And then recently, a couple of years ago, became CEO again. So his thesis was, how do you take an opaque data set and make it transparent to the users? And his takeaway from it was power to the people. So one of the things I've outlined in the book is 11 frameworks for that. So another good example is what I call the waterline example. Like when you think about every problems in your market that exist, there are problems that fit above the waterline and problems that are below the waterline. And what I mean by that is there may be small problems above the waterline, but you can actually make money there. Where you look at some of the big problems, you're like, that's below the waterline, but how do you change that? Right? And the answer is you invest in the above the waterline ones first, and then you figure out how to pull the waterline down as you go. But like you and I had been in the education market as well. It's like, how do you transform education in America around retraining into tens of thousands or hundreds of thousands of people? And the answer is, wow, that's a big problem. Where do you start? right? And you have to start above the waterline to make it work. So in the book, if you have 6 ideas or you have one idea, the thing I encourage you to start off with was, here's the topic on ideation. Here's how you do customer development. Go find out if the customer actually cares. And then how's the process for tracking that. So one quick side note on that, Will, I mentioned my grandfather before we were talking. So in 1911, he had the first Ford garage. And, people often will say, well, Dave, Henry Ford said, if I asked my customers what they wanted, they'd tell me a faster horse. And I would remind people that that was true in 1910. And today we have this thing called the interweb. So people have alternatives and they have choices, but you need to go out, and how you ask those questions definitely matters. And I've outlined a very step-by-step process that kind of recognizes kind of best practices from Steve Blank and Eric Ries. But it's really designed for earlier in the process. Like Lean Startup is an amazing book. And Eric's thesis is, when you have 1,000 unique users every month, this is what you do.
Right.
For many of the folks listening, they don't have 1,000 unique users in a year or 3 years. They have nobody. So the question is, what do I do first? And that's what I've tried to answer in the book.
Yeah. So I've noticed, working with startups the last 15 years or so, that there's a characteristic of a founder that would say that they have a product vision and they're just going to carve out a market, whether people like it or not. And they always point to Steve Jobs and the iPhone, and it's like, this is what the people want. And then there's the people who read Eric's material and think, I just need to measure everything. And based on data, I'm going to move my product feature and product roadmap on XYZ. And as my background's in science, I spent the better part of a decade in a bioengineering lab. So I take data and statistics very seriously, because it was a matter of graduating or not graduating for me.
Right.
So I still have, it's still sort of triggering for me, all things statistics and data, especially when it's not done well. So I'm a little bit of it's a pet peeve of mine when people do statistics haphazardly. So I'm always cautious when I work with founders of, are they actually just optimizing for a local maxima, right? Are they collecting data based on a relatively low number of data points and making decisions about their products that are actually leading them in a direction where there's a much larger market and a much larger opportunity over here, but they miss it? So how do you advise, and how do you think about the dance between product vision and pivoting based on data?
Yeah, it's interesting. They've done a bunch of stuff in the emerging markets in MENA, and I'm starting to do some stuff in sub-Saharan Africa. And one of the consistent trends, Will, is that people will think about, like I remember doing a startup weekend in Moldova, right? And people think about their total addressable market as Moldova. And I'm like, whoa, what do you mean Moldova? Like, how about the rest of Central Europe, and how about all of Europe, and how about the globe? And right. I think founders tend to think about the markets they're in, which is super interesting. In the US, we have a big market. But if you're in a niche market like Egypt, the answer is I've got to think about Egypt and the GCC. But let me come back a little bit back to the data set. If I look at the unicorn list from CB Insights over the 400 unicorns over the last 3 years, right? Almost all of them have something in common, that it doesn't lead with product first, it leads with total addressable market first, and what I would call a nascent market. So most of the big players have gone after a category that didn't exist as $1 billion market when they started. It may be a multi-billion-dollar market today, but when they started, it wasn't a multi-billion-dollar market. Mm. So a very consistent trend there is that market matters more than product. So, and what I mean by that is that a great team in a crappy market is going to produce bad results, right? So my analogy is a wave, right? If you want to go to the north coast of Hawaii and ride a big wave, the answer is the product needs to be right, the surfboard, and the timing needs to be right, or you're going to be waiting a long time. Mm. Now, if you want to go to the south coast of Hawaii and ride a wave, it may be 3 feet, right? So there's nothing super exciting about that one. Investors will look at it and say like, eh. So my point is a great team with a great product in a super tiny wave are going to get really marginal results. They'll get crushed from an investor perspective because there's no outcome. And if they're truly, the self-proclaimed visionaries you find on LinkedIn, then it could be 3 years before the product is actually ready. And I'll tell you, that's super expensive, because right. you're trying to train the market, and you're like, you don't have enough money to train the market. So So I think market comes first is my observation. I used to say team comes first. I've kept the blog up to just institutionalize and not have revisionist history.
Right.
But today I'm definitely under the opinion that market comes first, and timing and market together make a huge difference. So I'm glad you have a product vision. That's awesome. It should be informed by data, which is customer interviews. And hopefully you do have a really transformative product at the end. But keep in mind, think of this as I have launch and I have scale. A lot of founders live their life as if they're in scale today. But I'm really just trying to get them from launch and survive this, the terror part down here before you hit the hockey stick, and compress the time it takes to get to the hockey stick, right? Because that time is going to exist, and if you don't have enough budget, you'll just die, right? Which is why the math is the way it is. So keep the product vision, but also look at my reality of what can I ship in the time frame I have, with the engineering talent I have, with the budget I have. And you'll keep iterating on that as you go and get to the hockey stick is the goal. But keep in mind, you have to survive long enough to get to the hockey stick, which is where founders kind of, I think, especially first-time founders, are a little bit naive. You're like, oh, I didn't have enough personal runway. Should I go raise money? And it's like, well, if you don't have any traction, you're not going to raise money these days.
Yeah. I really like the analogy of pick the side of the island that you're going to surf in, right? Do your homework on your market, pick a market. Yeah, no, that's good. And I think even to extend the surfing analogy even more, so you find the side of the island you're going to surf in, and you build a product, you got your surfboard, you're riding this wave, and maybe the how to pivot your product is almost like which way you go. Like for those who have surfed, if you go this way, sometimes the wave is amazing and you have a nice long run. And if you go this way, it'll collapse on you or the wave falls apart or something. So how do you advise founders when they're on that wave, the wave is going, how do they know whether to turn right or left? Like, how do you actually use data to inform your product roadmap and to inform your growth roadmap?
Yeah, I'll switch analogies with you a little bit, because I think it's really it's all about training.
Yeah.
Right. So as you start to do customer development interviews, one of the things I outline in the book is a process to capture that customer data and capture email addresses and capture who said that they would buy it if you had this feature. Now, if you only do 5 customer interviews, you can remember all of them. Well, technically you can't, but you feel like you can. But when you do 50 or 100 customer interviews, you definitely can't remember all of them.
Yeah.
And let's face it, if you and I had a product idea today, and we had a list of 300 people who were interested in this particular product, man, our time to ship a product that group had consensus on would be so fast, right? Most founders don't have that list of 300. So you're going to start this month. I'm going to start doing interviews. And the last question I'm going to ask is I'm going to ask, hey, well, can I put you on my monthly email update for our progress? And almost everybody will say yes. And the ones who say no, frankly, were never interested in the first place, and you don't want them there.
Right.
But in a year, you're going to have 300 people on that list, or hopefully, at least 200 people on that list.
Right.
Who, when you send out a monthly update, you're going to say, here's what we shipped this month, here's what we're going to ship next month, and here's where I could use your help.
Yeah.
Now, that email should take you about 20 minutes to craft. That's it. And you should send it out regularly on the first or fourth or whatever day of the month. Now, most people aren't going to respond to you, but the people who do respond to you are going to become your super fans, right? And they're going to be like, oh, that feature is awesome. Like, if you added this, I would buy it. But again, if you don't track the data, it won't matter, right? You'll be like, I'm convinced that everybody wants a black car, right? And that's really not what you're building. What you're building is for early adopters, people who can be fans. And again, you're building I have an ICP, ideal customer profile, at launch that's different than my ICP at scale. But I have to sell it to those customers. And in the book, I outline the concept of launch addressable market, right? Versus I've got this abstraction, which is pretty academic, called TAM and SAM and SOM. And I try to connect that to your first 10, 100, 1,000 customers as your launch addressable market. It's like at the first 10, you and I as co-founders are going to go sell them ourselves. At 100, we're probably going to have a salesperson.
Yeah.
And at 1,000, we're definitely going to have a sales team. But until you and I can sell the first 10, the answer is we don't know. And that's really about how do I connect that abstract concept of TAM with my go-to-market strategy of 10, 100, 1,000.
All right. So let's say a founder has a small team They have they've identified the market. They've assembled the product. They have a reasonable go-to-market strategy. How do they best engage the investor community, right? At this point, maybe they've just done their own sweat equity, or maybe a little bit of friends and family money or something. But how do they have? At what point do they start having conversations with the investor community, and how should they even think about the industry in general?
Yeah, so great question. So one of the things that I've found, and it's what I call stage appropriate capital in the book, right? There are what you'll find from meeting with, you can get meetings with VCs, right? Because they take meetings for a living. That's what they do. And they'll say nice things about you. Oh, that's awesome. Let me know when you have traction and let's talk again. Now, will they define what traction is? And the answer is no. And so you felt good about that meeting until I'm going to tell you right now, it actually wasn't a good meeting. They were blowing you off and patting you on the head.
Right.
So stage appropriate capital is super important. Like, how much money do you need and for what deliverables becomes your first question. We need $250,000 to finish this prototype into a scalable version we can launch in AWS. Awesome. So assuming you figured out the market size is interesting. Keep in mind, the early days, you're raising about, this is an awesomely big market and we have a kick-ass team and we built a great product. Great. You have no data to show the investors. They just have to believe in you and they have to believe in the market. But as you start to go out and talk to investors, you're going to do a similar process with the investor updates. Now, originally, the first 6 months, investor update and customer updates can be the same. But after about 6 months, if you're really making progress, you're going to separate those investor updates into two things. And the update's going to be slightly different, right? This is what we build. This is what we learned. So it's what I thought, what I learned, and what I'm doing about it. So we thought this, we learned that, and this is how we're approaching it. So my last full year working for a venture capital fund in the Northwest, I looked at 167 deals and we invested in 2. Now, I looked at super, super early deals. So had I stayed in past the fund formation, they were raising fund 2, ended up not raising as much as they thought, and they weren't going to open a Seattle office. I'm like, you guys don't need me to do that. You can do it on your own.
Right.
So the challenge there is I have to begin to build relationships with investors before I have something to actually get them to invest in. So I'm going to build a profile list, and I walk you through in the book a very step-by-step. This is an enterprise sales process. I'm going to build a list of people who have interest in this space based on their, Crunchbase profile, their AngelList profile, etc. And then start to build out a list and do outreach to those folks and give them an update on what we're doing. So keep in mind, of the 167 deals I saw that last year, 90% of their plans were built on that. I can't do anything in this slide deck without getting $1 million from you and somebody else, or somebody else in combination. Which is super painful, because I'm like, well, what are you going to do next week when we don't fund you, like tomorrow? Right? And they're like, well, we'll have to rebuild our plan. I'm like, go rebuild your plan. So 10% of the companies were like, listen, Dave, this is where we're at. This is what we're doing. With or without you, we're going to go do this. I'm like, ooh, I want to watch them.
Yeah.
Right? Now, with you and with that $1 million, we're going to take this thing in Q4 of next year, and we're going to move it to Q1 next year. We're going to take this thing in Q2 next year, and we're going to move it in Q4 this year.
Yes.
Like, we're going to take everything we're going to do without you and accelerate the pattern. I really want to watch that one.
Yes. Gold. Right. Founders, listen to that.
Oh my gosh.
Very good advice right there.
It's painful. Now, the 2 deals we invested in, amazingly enough, we watched them. We saw their monthly updates, and they happened to be the ones that said, hey, we told you we were going to do this. We're actually 120% of plan. And I'm like, really? We should definitely talk. So what changed in that, and these are, again, 2 deals that we led, not just deals we invested in.
Right.
So if you have a plan with or without investment, and you exceed the plan with or without investment, you don't have to worry about, investors will reach out to you, right? And one thing's for sure about finding a lead investor, which is super critical, and I talk about in the book, is you have to be lead investors will pull your deal along. Like, you don't have to call me and say, hey, Dave, you still want to meet? Like, if I'm going to be your lead, I'm going to pull the deal, right? You don't have to push the deal.
Right.
So, but the first off is you need to be in the top 10%, and the top 10% says, this is the plan with or without you, and this is how we're going to be scrappy and get it done.
Yeah.
And then if you actually continue to do it, that's where investors get super interested. Versus you don't have to sell me on it at that point, because I've been following you for a while, and those monthly updates are actually doing the heavy lifting for you, which is super important because you got to, as a founder, you have your top 10 list is huge and you're under resourced and understaffed and, you're under everything, right? And you're being a generalist because you can't hire to do everything you need to get done. So having something help you do the work for you by doing some of the heavy lift is super important.
So how do you think about no code, right? There's the landing page, no code, all the number of ways to validate your idea in a market that you want to play in, and a team you want to play with seems to have been exponentially increasing the last 5-10 years. How do you think about the whole validation game and no code movement?
It's super exciting. I think this is probably, aside from AWS, when I did my first startup, we raised millions and millions of dollars to have, a cage in Exodus and a backup location in our building with redundant servers and physical hardware. And AWS has done so much to bring the cost of doing a startup down. And I think, folks like, Bubble and others are just doing amazing things to make that low code, no code thing work. So quick side note on it. In the time, if you're still looking for a technical co-founder and you've been looking for a technical co-founder for a year, 18 months, I would tell you should be more productive with your time and learn no code or learn to code. Now, to be clear, and Will knows, I am not a fast coder. But if you said, hey, Dave, you have an idea, can we hack something together over the weekend? The answer is absolutely. I would hack something together and go test it out. I'm kind of in the extreme end. I would even do landing pages and spend $1,000 on Instagram ads to validate an idea before I spent $1 building anything.
Right.
I would send people all the way through the checkout process and then throw them a 404 error or tell them I'm out of inventory. Right. I wouldn't capture their credit card information, just to be clear.
Yeah.
But short of that, I would send them all the way through the process. And founders sometimes are like, but Dave, you will disappoint people. I'm like, well, it's an MVP. You're going to disappoint people anyway. Right. So, the definition of an MVP, Reid Hoffman's comment was, if you're not embarrassed by it, you waited too long to ship it.
Right.
Okay. So I tend towards that predisposition anyway. So when I look at the low code, no code solutions, it's super exciting. You can get a clickable demo super fast. Is there a learning curve for you as a founder? Of course. Do you need to spend $10,000 on a prototype? No. Right. So between things like low code and no code, and I haven't found a great market on Fiverr for that yet, but that market's coming up for sure.
Right.
But I will look at my task list at the beginning of every week, Will, and be like, this is something I can pay somebody on Fiverr $25 to go do.
Right.
Right. And I don't even don't step on dollars to find dimes. If you can find somebody on Fiverr or Upwork to build a prototype for you in no code, you still have to write a spec. So one of the things I outline in the book is a very step-by-step, 4-step process for what are your requirements? What are your specifications? Stuff that what's your tech stack? Keep in mind, your MVP, you're going to throw it away. So does it have to be on the ultimate right tech stack? It'd be nice if it was, but if it's not, it's okay, right? So, but yeah, those solutions are going to open up a whole new area and drive the cost of, doing a startup down, just like AWS did, which is super exciting. I wish I would have thought of it. I have to be honest and slightly jealous.
So let's talk about 3 types of debt in a startup that maybe founders don't think about very much: operations debt, technical debt, and growth debt. Obviously, technical debt is when you just go off and run and you're building lots of things. You're not writing enough tests, or you have lots of spaghetti code everywhere because you're just trying to get the idea validated, which I'm a fan of. I'm very comfortable racking up debt in these 3 areas. But how do you advise founders with regard to we're going to ship, we're going to get data from customers versus cleaning up the house and paying off debt in those 3 areas? Or how do you even think about it from a framework perspective?
Yeah, I think of it as major milestones, right? So as you look to think about it this way: at some point you're going to ask the question, hey, I think we need to increase our option pool, right? To take on more people. Mm-hmm. Those should be times that you look at the same thing for those operational forms of debt, right? Because we're going to go out and raise institutional running with a venture capitalist. How much capital do I need? Right? And you're like, well, actually, I need more than I think because I have, we don't have good processes in place that will scale operational debt, right? We have code that we're supporting 3 or 4 different ICPs. So I remember T.A. McCann launched a company called Gist. He sold to BlackBerry way back. But at one point, they had to drop their initial ICP, or ideal customer profile. The product had shifted over time, and that ICP was no longer a customer they were supporting. So the hard decision there was like, we don't want to turn them off because we know all of them by name. They were our first 10 of the 100. And they had to just make a decision to like send them notifications and let them know they were shutting those features off because they couldn't continue to support it. Right, the support cost alone was a single person versus working on the new code that allowed them to scale. So I would kind of look at those things as like, every time I'm looking at the next tranche of funding, I'm going to look at those things and say, well, let me be realistic about what's here. Because at some point you're going to make a decision of, I have to answer this technical debt decision or build this new feature. But if I build this new feature, it could crash. Yeah. Right. And your head of engineering is like, Dave, it's going to crash. And you're not technical. And you're like, I think it will be fine. Right. But when your head of engineering says it's going to crash, like our server loads are off the hook, or we're going to show this picture of a net supporting the whale in the old Twitter days, right? You need to be ready for that as well. And I would look at it in each of the milestones for fundraising, right? When you bring on a COO, right? I will tell you, I'm really good at details today. That is not my native state. But I had to learn that because I couldn't hire it, right? So like, do I hire a technical person or a COO? Well, that's simple, right? Do I hire a revenue person or an overhead person? That's simple, right? So in the early days, you're always making those decisions. So if you're not good at finance, that's okay. You can get good at it. If you're not good at no code, that's okay. You can get good at it, right? But you really just have to prioritize your time. In early days of a startup, you're defined by what you say no to.
Right.
As much as what you say yes to.
Very, very important. Yeah. So there are many hearts and nuggets in the book, but one of the key hearts is around the business models. And for founders, as they're formulating their idea, they're identifying the side of the island to surf in. What was it about the business models and getting data around business models and helping founders think about multiples around business models and the well-worn paths around business models that was so intriguing to you? Like why? Because you're definitely the guy that I refer to and refer people to when it comes to thinking through these different business models. Why? Like, what was it that was attractive to you?
Well, it started off as kind of an innocent question, actually, which was super funny. So a founder came to me in Seattle and said, hey, can I have a copy of your financial model? And I was like, I'm a community guy, so I'm like, yeah, I'll give you a copy, you'll break it, and then you want me to fix it. And I'm like, that causes problems. And then I was like, and besides, mine's a B2B subscription business, and yours is a B2C marketplace business. Right. I'm like, those are just, they share common language, but they're just different, right? So that led me down this, what I thought was an innocent path at the time. I went back to the CEO of Crunchbase. They didn't have an API. And I reached out and said, hey, can you give me a list of like every seed-funded company for the last 18 months? Thinking, it's a good place to start. So it ends up being 2,564 companies. Yeah. Or 2,654. So my son at the time was in college, so we hired an offshore team and we went back and looked at their product and pricing pages on every company. And we basically broke down what revenue model are there. So there's 14. So because it took me so long to do it, that turned into a 6-year longitudinal study of those 2,654 companies. Again, not my original intent. This feels like, Frodo and Sam at the edge of the Fire going, why are we leaving the Friar? Like the Shire? Why are we leaving? Right. So it was never my intention to like create the definitive business model guide or revenue model guide. But what we learned in the process was we tracked these companies over 5+ years. We basically, anytime the team came up with an other, I would reach out to the CEO and say, hey, I'm doing a research project on blah. I'm trying to figure out what your revenue model is. What is it? And so some of the surprises, one from the data perspective was the number of seed rounds has exploded from, usually you would do a seed round, a pre-seed round, a seed round, an A round, and a B round. Seed rounds went from seed 1 to seed 10. Right. So seed rounds became much more milestone driven than they were historically, which means it was taking people longer to hit particular milestones is the observation. The second thing is we looked at all the companies who failed. And then we went back to the Wayback Machine, which is the Internet Archive for the folks who don't know. So you can go back to waybackmachine.org. And you can look at their last cached pages. And 80 to 85% of the companies that failed well had no call to action, no price, and no really clear value proposition was kind of the three things they all had in common. Now they had things like call us for price, which I will remind people from a go-to-market perspective is, if you're my boss and you task me to go find a product that solves a problem, and I find 4 companies, 3 of them have price and 1 of them doesn't, I'm not actually calling you for price. Because it just makes me look dumb to my boss, right? So there was no clear call to action. So the aha there was around pricing. So I ended up writing a chapter around pricing and how do you engineer pricing and do A/B testing on pricing and what's the engineering approach. For a non-engineer, I'm very systems thinking, right? Which is weird, I know, from my arts friends. So so that ended up being a chapter we wrote on, it's better to have a price out there and be wrong, right? Even if you have to set a higher price and discount the first year than it is to have no price, right? Because when you launch your price, you're going to be wrong anyway, right? Yeah. It's like doing a financial model. You're going to be wrong. Orders of magnitude wrong is really the thing we're looking for.
Right.
So the 14 revenue models became the outcome of that. To give people context, if you remember back to Groupon, so Groupon, it was a new revenue model at the beginning. Revenue models are not defensible. If you remember the thousands of Groupon knockoffs, right? Because I think you were in Chicago at the time, right? And there was like Groupon knockoffs everywhere.
Yeah.
So Groupon ended up becoming a combination model of commerce and lead gen.
Yeah.
Was the way they monetize by the models. And combinations are actually one of the models that surprised us as well, because in venture land, you'll hear people say, we think you should be a pure subscription-based business or a pure SaaS company, which is super weird because SaaS is a delivery mechanic and subscription is the monetization mechanic, right? So then there's a bunch of SaaS products out there that are free, right? So they're not actually, it's not a pure play SaaS. It's really a stupid thing for venture capitalists to say, but don't argue with them, right? And say, Dave said I could argue with you about SaaS. Don't do that. That's not what I'm saying. So you have subscription models, you have metered services. I won't go through all 14. You can look it up. I'll make sure I give you the excerpt, the link to the excerpt for the book. So all 14 revenue models are broken down there.
Great.
And then the thing we also went through is what were the conversion metrics and heuristics that mattered for each of the 14 models. So for example, on subscription, I have number of people who register, sign up for a trial, convert to paid, what's the average revenue per user, and what's the churn. So you may find that you have your own unique KPI for your business. Maybe. Like I've had this argument with a bunch of VCs because they're like, we think that every company has its unique KPI. I'm like, maybe. But while you wait to find that perfect KPI, here are the 5 that I would track. They are super prescriptive. Like, so go find your unicorn, but start here. Start with these 5. So for each revenue model, I've broken them down. And then the point of that exercise is really to go to the founders and say, I hope what you're building is unique. How you monetize it is basically never unique.
Right.
So there's been one new model, 2 technically. Coins and tokens were a new model that emerged during the data.
Yeah.
Ultimately, there's no drivers to that. It was a financing model that the SEC found to be illegal.
Right.
So park that one for a minute.
Yeah.
Groupon converted to combination. And then we had this new one called metered service, which started with subscription. And if you remember your old cell phone bill, that was a metered service, right? Every text you did, you got charged extra for. But in B2C, it's a negative customer experience. In B2B, it's actually a positive customer experience.
Right.
Because if I buy a Twilio number and my usage goes up, it means my customer's usage goes up, which means I'm going to get paid more money.
Yep.
So AWS, Twilio is a great example. Azure is a good example. And by the way, what's interesting is the multiples on exits are dramatically different on each of the revenue models.
Yes.
So I'll give you a couple examples. So you and I decided to do a consulting company. We do $1 million a year. It's us and our team who's delivering the consulting. And we decide we're tired of doing this. We want to move somewhere else and go to Florida or Austin with all the other startup people. Great. And we're going to sell our company. And so that $1 million a year subscription business, $1 million a year consulting business is going to sell for roughly $1 million.
Right.
And we'll typically get paid in what's called an earnout, which means the company's going to use our cash flow for the next 3 years to pay it. They're just going to pay us in advance and then use the cash flow to pay themselves back. That's not a bad exit, right? But it is a services business, which means it intrinsically doesn't scale, or it's not a venture scale business. So let's compare that to $1 million subscription business. So $1 million subscription business is going to sell between $7 and $12 million. And I would argue from a founder perspective, it takes almost the same amount of time to build $1 million services business as it does to build $1 million subscription business. I got to digging into some of that data too, but to give you the range of differences, services at the low end is 1-to-1. Things like marketplaces, so think Alibaba, eBay, or Uber, are in the 4-to-6 range. Niche e-commerce businesses, think Lululemon to Wayfair, and this is all based on the public comp data, is 3 to 8x.
And this is all on top line. This is all top line. This is Ebitda isn't, or obviously.
Because startups are so tough to do EBITDA on, so you can't do a multiple of EBITDA. You have to do a multiple of revenue. And in most cases, the companies that are going to be acquisitive are big public companies who are buying revenue. So the reason I bring that up is, as a founder, if you can think about, I'm going to choose between a subscription business or a transaction fee business, the difference is, a factor of 2, right? A transaction fee business might be 4x on revenue, where a subscription business is going to be 8 to 12x on revenue. So I bring it up not that you over-index as a founder on your exit multiple and how to optimize for exit. Not the point. It's also not the point of how you value your company in the early days, right? Dave said, I'm doing this, I should be worth 12 times. The point is that as you're building the business, there are some things you should think about that are out on the horizon, like who am I going to sell this to? How am I going to exit it, right? And some people build a great lifestyle business and they love it and they employ friends and family and they live in a great community and that's all awesome. But at some point, most businesses get sold, right? And you should at least know going into it. A friend of mine pre-read the book. He's in the financial services industry. And he called me after he read it and said, I'm pissed. I'm like, what do you mean? He's like, you just reminded me that after all the work I put into the business, I'm going to sell it for 1 times revenues. I'm like, well, I didn't make the data up. I'm just reporting the data out, right? And he sold the company about 6 months later, and he still just shakes his head. He's like, yeah. And I'm like, so it's something you need to think about, but not optimize for. So as you look at the book, just know that there's a compounding effect. Like it's super risky to launch a new company and a new product, and your first milestone is product market fit, which, by the way, I think is math. Not like, how do you feel about it?
Right.
So at least pre-product market fit is math. So you should think about it from the terms of which, if I'm going to have an outcome, which direction should I go? And if you can choose your revenue model, which many people can, then I would encourage you to choose the high end of them if you can. But you're not going to build a new revenue model at the same time. So the other change we saw in the data set was licensing, which is where I started my first company, right? Software licensing has actually been in significant decline as companies migrated to subscription. And I remember 15, 20 years ago when Microsoft was like hand-wringing about, can we migrate from, what's the impact on revenue going to be if we migrate from licensing to recurring revenue? And now the answer is, why would we ever do anything else? Like you can order your LaCroix subscription on Amazon on a subscription these days.
Right. So last question, and we need to do a part 2. I'm sure there are going to be a bunch of questions, so I'd love to have you on again. Last question for now. Something you mentioned earlier, which was asymmetry in VC conversations, the asymmetry of data, that they know things that you as a founder don't. There are a lot of things wrong with venture capital. This is partially why we started Proda, was because there was a lot more value add we thought we could bring to the early stage founders in terms of operational help, connections, et cetera, et cetera. But for you and your experience with the way that you think about the VC industry and the way that you think about how founders should approach it and where the value add, where the value transfer is, can you speak a little bit more to what you were talking about there with regard to the asymmetries that exist?
Yeah, I'll give you 2 concrete examples. So you're a founder going out to raise money. In the early days, you raise money from friends and family, which can make Thanksgivings super awkward. But you have information asymmetry in your favor. You like the product, you're super jazzed about the market, your team's doing awesome, you're shipping product, and your uncle, grandfather, cousin give you money because they believe in you, right? And you give them terms that sometimes aren't the greatest terms. So you gave them a safe note or a convertible debt with a cap, and the cap was at 10. And then when I come along and see that as an investor, I'm like, you need to fix that. That cap should have been at 3. Right. And you're like, well, but they said yes to it. I'm like, but so here's where information asymmetry and pricing asymmetry really matter. when you're selling your stock to somebody who doesn't know anything about private company stocks and venture capital and startups, unintentionally you're taking advantage of those people because they should get the best deal. They are taking the most risk. When you come to me as a VC, I know the deals I've seen, the deals I've passed on, and the deals I missed. And I know what the pricing and terms were of those deals. Now, granted, it is a super small data set, right? But it's a bigger data set than you as a founder have.
Yeah.
So when you come to me and say, hey, Dave, we want to do $1 million with 10 million cap, I'm going to be like, your price is off. Right. And if my analogy is being on the pitch on the soccer field or the football field for my friends that aren't in the US, you can be on the pitch, which is I'm between the out of bounds and I'm between the goalposts. Right. As long as you're on the pitch, you're OK. If you're up in the stands, investors will nod and smile. And as soon as you leave, they will chuckle that it's so cute. Right. And then some people are like, way the hell out in the street. They're not even in the stadium. Their numbers are so weird. Right. We're going to sell 10% of the company for $2 million. But we're pre-revenue. And the answer is no, you're not. So it really is based on that information asymmetry. And at one point I was thinking about starting a company that did that. And I realized, well, it's just like, it's a super nice $4 million business that would be great for founders,
right,
but it's super hard to scale.
Yeah.
And I'm like, it takes as much time to build one of those businesses as it takes to build a $100 million business. So sadly, I sidelined that because I would love it if the data was available for founders to say, here's 6 months of revenue data. Here's my revenue model. How do I benchmark to my peers? Like that would be super interesting. And we started to build a prototype and realized it was just too hard to get the data in an automated fashion. That's forward-looking data, not trailing 12 data. Like I can get your QuickBooks data, but it's hard to get your HubSpot data looking forward.
Right.
But that's where information asymmetry exists, and just know that it's there and going into it. It's probably why I'm not in VC anymore, right? Because I was always having the conversation with founder, like, well, kind of, here's how you should think about it, right? And my partners were like, no, we should get extra points in negotiation, and I'm like, no, I don't think so. Like this is how do you level a playing field and make your portfolio company CEOs smarter, right? Because it will serve them better long term.
Yeah, that is one of the things that bugs me. There are many things that bug me about the VC industry, but that is one of them. And that they are pumping out all the material because they have the budgets to crank out the media and growth to take all those meetings, as you mentioned earlier, right, where they pat the founder on the head and say, "Oh, that was cute." And I desperately want to talk to the founders as you do before they go into that meeting, so they can at least get into the pitch. They can get in the ballpark, have the education to be able to speak the language, because it really is a whole language in and of itself. Like I'm sure those listening in that aren't familiar with VC and startups, maybe we've been talking a lot of inside baseball, but this language of startups is important to enculturate yourself in first before you go out. And a good way to do that is to read Dave's book, because there is a wealth of information in here. So Dave, I really, really appreciate your time. Where's the best place for people to go buy this book and follow you and learn more about you?
You bet. So Amazon has it. It's easy to get there. If you want to go to dkparker.com, you'll see all of the online choices for you. So if you want to support the independent bookstore, Audible version will come out at the end of May. So for those of my friends who say, when I think about this, I hear your voice in my head. Sorry, you're actually now going to actually hear my voice in your head. So that'll be out at the end of May, early June. And if you listen to me on 2x speed, I think you can finish the book in about 4 hours and 20 minutes. So I'm not sure you want to listen to me on 2x speed, but 1.8 maybe.
So any final words? Like, what are the next things on your horizon? The next questions for you, or things that you want to say to folks?
Yeah, we're working on a couple of things that how do we make entrepreneurship more accessible to people who've traditionally been disenfranchised by it, so BIPOC founders and women. I think that COVID has disproportionately pushed women out of the workforce in entrepreneurship. So I'm super excited about some of the stuff we're doing there. So I think the big takeaway I leave your listeners with is, so I have my calendar at the bottom of my signature, right, on all my emails. But in the application, or in the tool I use to book on my calendar, one of the questions I've started asking is, tell me who you're mentoring that doesn't look like you.
That's good. Because
if you're not, I'm kind of swamped right now and a little busy. But if you're actually paying it forward and giving first, which was something that Techstars institutionalized, but we were great at from the Startup Weekend perspective. Yeah. Like if you were mentoring people who don't look like you, like I am super happy to support you. if you're like, I'm super busy, Dave, running my startup, then the answer is, okay, I need you to be a little more community minded because there's already somebody who's one chapter behind you that you can help.
Right.
If you're great at product and they're great at marketing, like this is a great relationship. So as a startup, you don't live in isolation, and I would encourage you not to, because the amount of depression in startups is super high because us as entrepreneurs are a little bit weird that way anyway. But mentor somebody who doesn't look like you. Like those are my table stakes, right? When somebody says, hey, can I get in your calendar? My question is, so tell me somebody you're mentoring who doesn't look like you.
It's good.
And if the answer is yes, then I'm happy to meet you. If the answer is no, then go do that first and pay it forward and then come back and talk to me.
It's good. It's good. Well, Dave, really appreciate or love your book. Excited to tell more people about it, and really appreciate your time.
Yeah, thanks for the time. Well, I appreciate it too. Thanks, everybody.
All right, a couple quick things before you go. Number one, I have a general newsletter where I write about technology and startups and health science and teaching people to code. And I write about a variety of different subjects that we talk about on this show. So if you go to wclittle.com, there you'll be able to subscribe, and you'll also be able to subscribe to particular topics. If you're just interested in one or a few of them, you'll be notified right when I publish new content in those areas. Number two, my partners and I at Proto Ventures have a portfolio company called Startup Rocket. If you go to startuprocket.com, there you'll be able to receive coaching guides and customize an operations framework for you and your team and your advisors to be on the same page in terms of what is the appropriate next step for you in your entrepreneurial journey. And finally, if you wouldn't mind leaving a review anywhere that you have listened to this podcast or watched this podcast, it'd be super helpful to help those who might be interested in consuming this content as well. Thank you.